Hello and welcome to BloombergQuint. My guest today is Jatin Dalal, CFO at Wipro. Wipro came out with stellar quarterly numbers, Q1 numbers, 12%, 12.2% growth quarter on quarter, which is almost 38 quarter high quarterly growth for them. Jatin, take us through this 12.2% growth. Break it up for us from an organic and inorganic perspective, how you achieve that growth.
Sure. So overall, quite a strong quarter, Sajeet. As you mentioned, it is among the best Q1 that we have had in a long time. We continue to see great traction in the marketplace, and we had guided from 8% to 10% for quarter one, but we saw strong tailwind in the business in terms of sheer momentum of the business, and we delivered 12% in constant currency terms and 12.2% in reporting currency terms for quarter one. Of that 12.2%, the growth which was outside of Capco in aggregation, which came from April 29th onwards, was 4.9%, and the remaining came through addition of Capco for 2 quarters.
Give us a sense of the quarterly guidance that you gave for next quarter, 5 to 7% growth in revenues. We saw Q1 a large bump coming in because of Capco, but certainly when you go to Q2, you've been very conservative in giving a revenue guidance. Why is that?
Well, this is not a conservative guidance. This is the guidance as we see our business, and I think it's a healthy growth guidance. If you take the first half performance with this guidance, you would see that on a year-on-year basis, we would be delivering around 26 to 28% from a lower range to the higher range. So overall, we feel quite good about the traction that we are seeing, the way we have delivered in quarter one, and the way we see momentum for quarter two.
So when you see 26 to 28%, this is year-on-year, or this is the first half to second half of last year?
This is first half of last year versus first half of this year.
And still, your guidance for the full year is double digit, right? Which
Yes,
to ask the question.
Yeah. So let me respond to that, Sajid. First of all, we don't guide formally for the full year, so there is no number that we have mentioned. Typically when you guide with specificity of the numbers and currencies, etc. What we have given is a commentary which says that if we see our quarter one performance, which has been delivered, and quarter two guidance that we have given, it seems certain to us, it seems logical to us that we will be well ahead of our double-digit growth in quarter two in FY22, and that's a commentary that Thierry spoke about earlier this afternoon.
How do you look at the margin front there? Because you only accounted for 2 months of Capco in Q1, and the next quarter will see full impact of Capco coming in. What kind of margin compression are we going to see there? Plus, you have Amphion to complete and integrate, and 3 wage hike cycles to comprehend going into the quarters.
So first of all, I would like to start by saying this is a year of opportunity, and we should seize this opportunity. And how do we seize this opportunity is by making sure that we have sufficient talent to cater to the growth needs. So far, we have made sure that our talent curve is staying ahead of the growth curve or the demand curve, and that is, I think, the most crucial aspect about this year. With that being the key priority, we will continue to look at what we can do more in terms of margins. Our performance in quarter one, I think, is quite good, given the fact that we consolidated 2 months of Capco, and we had investments of 1 month in terms of salary increases, and also the fact that we had to hire laterally as we did not have sufficient number of freshers joining us. We will have a large contingent of freshers joining us in quarter two and quarter three, but certainly quarter one we had to hire a lot. So this year the overall margin is going to be a fine balance between making sure that we always stay ahead of our talent curve, and at the same time we don't let go margins completely, or we don't drop margins in a big manner. And I'm sure that we can leverage levers like automation. Offshoring is a big has been a big thing for some time. Pyramid will continue to get corrected. So some of those will start playing up in terms of improved cost trajectory for rest of the year. And that's what we'll have to play for, even as we keep first priority for this year as what we can capture from the current demand trajectory of the market.
So how are you going to adjust the attrition number, because 15.5% LTM, sorry, TTM, 12 months trailing one, which you're looking at 15.5%, and that's a big number to do it, and in a market where everyone is now fighting for the talent, especially with respect to new orders which are coming in digital space mostly. How are you managing that point of?
So there would be two approaches to managing it. We will have to, in short term, we'll have to improve our retention, and even as we continue to do that, add an additional lever of fresh talent and reskilling, continued reskilling. These two would be medium-term levers. In short term, we will continue to work very hard on our retention of our people, continuing to make sure that we hire ahead of demand in the market. These are the short-term measures, and in medium term, we will add more freshers uh, as we have articulated. In FY23, we will onboard 22,000 employees. Is our plan. We'll make around 30,000 offers. We are thinking some joining ratio. It can improve, it can worsen, but certainly a number in excess of 22,000 we will onboard in FY23 compared to FY22, which would be around 12,000. So we will continue to improve that as we move forward, Sajid.
On the employee utilization front, 77% is a gross utilization that you've reported. Do you expect that to go up as well? I mean, we saw the 77% is a little tad low for you also, right?
No, it is probably the best utilization we have seen, Sajid. And I think why we are able to still manage with the utilization is the traditional definition of utilization has undergone a change with the distributed work from home setup, where you are not constrained by fulfilling a demand which is there in Hyderabad Development Center only by the the employee of Hyderabad Development Center. We can fulfill that from Chennai, from Bangalore, from Pune, from Calcutta, anywhere. So I think the traditional measure of utilization is getting tested. Otherwise, 77.7 is quite a tight utilization in the traditional physical model. But I think our supply chain team and HR has done a fabulous job of making sure that we leverage the current business model to its fullest and continue to fulfill demand by the distributed agile and some of the new sort of development delivery methodologies.
So, as you move towards a hybrid model where at some point in time, employees will come back to office, or some portion will come back to office, and some portion will be at various geographies working and contributing. What could be the ideal utilization level for that kind of metric? Because that would be entirely new form. I'm not asking Wipro specific, but I'm trying to get an answer from you on how the industry.
To define how tall a horse is, you will have to see how a horse is made up, right? So we'll have to wait what emerges in next 6 months or 9 months, and then we'll have to make a judgment. I think idea around this year, just as I said, it's a year of opportunity. It's a year of opportunity in many ways. I think we should all let go our fixations around some of the measurements and ideal numbers that we had of pre-pandemic, and embrace the new and see what is the boundary that we can push, and we'll continue to do that.
And from a P&L number, there's an other income of other operating income of 215 odd crores. Can you explain what exactly that is?
So it's a simple transactions. We had investments that were on our books. First was the business that we sold, data center business. Even as we sold, we had kept certain minority investment in that, and as that business got sold by the owners of the business to a third party, and we tagged along, and therefore we have realized we have sold our ownership off, and therefore we have realized that gain on what we had as uh, on the sale. The second is very similar transaction. There was a investment we had done in a company by name Denim Group, where we owned a 33% of that organization, and when they got sold to a new buyer, we had a tag along, and we got certain gain on account of that. These are the two transactions which have worked through in terms of the number.
Hmm. You know, just wanted to get an idea of the Amphion acquisition completion. You said there's some regulatory approvals pending. When do you have a timeline for that, and when do you see that coming in?
We do expect it to be closed in quarter two for sure. We expected it to close earlier in quarter one, but it has got slightly delayed. I think we have to respect that. Not all regulators are working with their base capacities now, and there would be certain administrative delays, and that is, we have to take it in the stride, respect the process, and go ahead when we get the guidance from the regulator. But I don't see anything on the horizon which brings us any uncertainty regarding the transaction. Transaction has been announced. Transaction, in all probability, would close, of course, subject to regulatory approval. And we believe, based on the fact that we have a straightforward commercial transaction of acquisition, we don't foresee any challenge on eventual regulatory approval. It's just a process. We have to satisfy whatever the requirement they have from an information requirement standpoint, which we think we are well covered that ground.
Reason why I'm asking is that your two acquisitions, Capco and Amphion, you made it very clear that your guidance will be about double digits, excluding these two acquisitions. Once these two gets integrated, what is the kind of range what we could see? If you can give us an idea of what is the kind of running rate for Amphion.
I think we did. So, Sajeet, we did announce a run rate for those businesses. MPN, certainly, when we announced the acquisition, and my request would be that you can refer to that rather than I sharing a different number or the same number again. And Capco, we have shared the sort of consolidated revenues of the current quarter that we have been able to consolidate, and that should give you a good sense of how it would pan out for the rest of the year. We had also shared full year numbers of Capco at the time of acquisition.
Okay, no, I get that. Coming to your verticals, especially banking and financial, that's our biggest growth band. Consumer was also one of them, which saw more than double-digit growth there. Banking 23%, which was a big boost. How do you see that particular segment going through? Is it a one-off 23% which we are seeing it, or you seeing a genuine traction by many of the clients in that specific vertical?
No, we see continued traction. Of course, that number has been further bolstered by the fact that Capco has been integrated from the current quarter, and Capco is principally in BFSI space, so it has certainly been helped. But overall, we see good traction, solid traction in BFSI, and we should continue to see a good momentum there.
What about client spending? What sort of client spending are you seeing? Is it discretionary, or is it transformational journeys that you are getting?
I think one of the effects of pandemic has been that most of our customers now believe that digital first business model is the way for future, and therefore you are seeing significant investments by all businesses, maybe both from traditional businesses to modern businesses to virtual only businesses. Almost every type of businesses are investing in a digital first business model, from architecting to customer reach to final fulfillment to cash collection and so on and so forth.
Mm-hmm. Any particular, your emphasis on retail and consumer means, are they picking up across?
Yeah, if you see,
retail has opened up.
If you see consumer growth, it's been very robust year on year, upwards of 30% as a business. So we continue to see very robust growth in consumer and new age businesses that it comprises of that vertical of us.
And your TCV has been what, $715 million in this quarter, if I'm not wrong.
That's correct.
Can you give a breakup of where all it came from? Some of the big ones.
It came all across geographies and units. It will be difficult to say which unit of it and give a further breakdown of where 715 came from, but it was a healthy mix of Americas, Europe, and other parts of the world.
Jatin, it's been a pleasure talking to you today. All the best for the future. Thank you very much, and
Thanks, Sajeet. Thank you. Take care.